Muniz. I'd like to welcome you to Sobel Insights. Sobel Insights is a weekly series. We provide some brief information on various topics. Our goal is to keep these sessions to 15 minutes. At this time, we do not offer CPE. If you have any ideas for topics or potential speakers, please feel free to email me. Today's topic is interest rate swaps. Steven Kuhnert, who's a vice president of commercial banking with Valley Bank, is here to talk with us about them today. And Steve, we've worked together a lot over the years, and me and a lot of other people are confused as to what these are. What are interest rate swaps?
Well, Brad, thanks for having me. And just to basically break it down, an interest rate swap is basically an interest payment stream exchange. So in the basic sense, and where we see the most common is you're exchanging a floating rate on the borrower's side for a fixed rate. So in essence, the borrower's getting their fixed rate for a certain set of time. The bank then brings in a counterparty who allows the bank to now have a floating rate, and it allows us to move some of that interest rate risk off of our books while offering a longer term interest rate fix to the borrower.
So the borrower still sees a fixed rate in essence. That's it, something else going on in the background though.
Yes, there's different transactions going on in the background, and but the net payment that the borrower sees at the end of the day is their fixed rate, and that won't change for the entire length of the swap.
Okay, because I've seen some statements that people get, when we're auditing the companies, and I say, "Can you explain this statement to me?" Not the banker, but the client, and they're like. So it sounds really good, and that you've explained it the way many people said. There's a fixed rate that the borrower sees, but the bank is protecting themselves, hedging themselves. What is the risk though of an interest rate swap?
So the real risk of an interest rate swap is that you may have a significant breakage if you are looking to get out of it quickly. And the breakage really depends on market, which means that it depends on where interest rates go from when you enter it. So let's say you enter an interest rate swap at 4% today. If interest rates continue to fall, that third party that is involved in this is not going to be enticed to get out of that contract because they're getting a higher rate than what the market's offering. So you're going to have a bigger breakage. Now, other things can factor into that as you are heading closer to the end of the term, your amortization term on your swap, that breakage goes down, and there's always a formula that goes into it. But if you're looking to break it day one or pretty quickly after you engage it, it can be a pretty hefty penalty.
And that's a very good comment you make, because we do see the statements, and remember, we've gotten them from you in the past. It's usually a nice Excel schedule, something very easy to read to show what the value of it is and what, in essence, the breakage fee is. And we won't go into the accounting. I'd love that, but I don't want to bore you and everybody else will go to sleep. So you mentioned, about the interest rates, the timing. Is there a good time to get into to engage or get into an interest rate swap?
Yeah, I think that the best time to really get into an interest rate swap is when you're looking for that steady payment stream. So let's say you're a manufacturer who says, all right, I'm buying a building and I want to know what my payments are for the next 10 to 15 years. I know that I need that fixed cost. So when I'm doing my pricing, different things like that. And I can't have the interest rate really risk. I don't want to play with that interest rate risk. I know I'm going to be in my building, or I know this piece of equipment is going to be on my premises for the long term, and I'm not going to be selling or refinancing in the next few years. That's the real time to go into an interest rate swap.
So I guess conversely, if you said, if you're going to be in it for a long term, and then previous question you answered, you said, listen, don't try and get out of this in the next day or next month type of thing. What would be a bad time or not a good time to engage in an interest rate swap?
So if you're buying a property looking to, let's say, turn it and flip it, that's not an interest rate. That's not ideal for an interest rate swap. If you say, okay, well, if the value goes up, I'm going to look to refinance this or extend out the term as much as possible. So let's say you think, okay, I'm going 3 years. Now I want to get a little cash out and now refinance it and go back up to a 25-year amort or 20-year amort. Those kind of changes to the transactions and the tenor of the loan can impact, and like we said before, kind of give you these high breakage penalties and could be very costly to you.
And I guess if you're an economist in some way, you start wondering, okay, which way are interest rates going to go? But if you're sitting there thinking, okay, which way are interest rates going to go, then you're thinking about possibly getting out of this earlier than you probably should be. And to your comment before, you want to be looking at the term as to how long you're going to be holding this for.
Yeah, yes. So what I would say is, I mean, you don't want to get into a swap to basically be playing it as a risk or to gamble. You don't want to gamble on a swap. You don't want to say, well, I'm going to be in the property for 3 years, but I think interest rates are only going to go up, because what we've seen recently is that things like the pandemic, where we started to see the rise before the pandemic, all of a sudden interest rates tanked again during the pandemic. So there's things that, and especially as we come to this recovery, they keep saying, okay, well, rates are going to rise, and we're steadily starting to see that, but it's not as quick as people thought. So you're starting to see swaps from a few years ago where people thought, okay, it's only going to go up. Now there's still high breakage penalties on that. Now, if you hit it right and interest rates go up, you may actually get paid to break a swap, because the counterparty will want to basically get them their money and re-lend it out at a higher rate. But if you're coming in as that's your primary game, I wouldn't recommend you as a swap for you. That's a secondary benefit, I would say.
Borrow and go play the market a different way.
Yeah.
Right. So are there any eligibility requirements on companies to enter into interest rate swaps, arrangements with the bank?
So under regulation, the borrower itself needs to have $10 million in assets or a $1 million net worth. Now, let's say a borrower doesn't meet that requirement, a guarantor could be put in place to confer that. And there's a little bit of vagueness as to how you justify the 10 million in assets, or not the 10 million assets, the 1 million net worth, especially on properties, because of things such as depreciation. So there's little ways to prove it based on the equity in the building, or the equipment, or the entity being our borrower. But for the most part, it's a pretty straightforward 10 million assets, 1 million net worth.
So if you're looking at real estate, you can actually use the market value of the real estate?
We do look at the market value and say, okay, especially it's a lot simpler on, I would say, acquisitions or different things where we get an appraisal. The key, though, to note is that if you, let's say, are buying a property that doesn't have that $1 million net worth, then you're looking more towards that guarantor and because you may have set up an LLC or things like that. So you may have a property for, let's say, $5 million. And if you, depending on what you put down, you may not hit that requirement. So that's where the operating company would need to come in, or a personal guarantee, to kind of confer that status to make them eligible, depending.
Okay. Is there any like documentation or like outside the normal loan application that's part of the process?
So what you need to do is every person under Dodd-Frank that engages into a swap, or every entity, needs to go to the gmeiutility.org, and they need to register for an LEI number. And that basically that allows you to engage in swaps. And then there's other kind of swap documents, but those are more on the legal side of things. From a borrower perspective, it's similar underwritings, similar producing of financial statements, maybe personal financial statements, tax returns, things like that. But other than just going and getting that LEI number, it's a pretty standard process the attorneys can handle the other parts.
Yeah, I've had a lot of clients enter into swap arrangements, and the process of getting to the loan through the loan application system, it seems very similar. I'm sure there's more papers that they have to sign, but you're all signing your lives away whenever you're doing loans, so it's not different. The one thing that people have to be concerned with that I've seen is that, they make the decision a lot of times without talking with everybody involved. And I always say to them, I like talking about accounting, and I just want to just have me involved just so you know what the potential could be for accounting. And I'm not asking you to comment on this. But I had a client that entered into a swap, and all of a sudden rates went down. They had a $2 million breakage fee. And in the accounting rules, they had to put a $2 million liability on their balance sheet. And which is fine. If you're not going to be exiting it, who cares? I know that the banks, I'm not speaking for Valley at all. This is Brad Muniz speaking. The banks know, okay, that liability relates to us. And when they go through their credit review, they're understanding it. It may trigger something, but it's part of an understanding process that they know that what that liability relates to. But the owners of the organizations see this liability, and what is that? I would have just done a prepayment penalty, but wouldn't have gotten as good of rates then.
Well, so that's why with all of my customers that look to engage in swaps, one of the first things I like to ask them is, what are your long-term goals? Now, where do you see yourself in 5, 10, 15 years? Do you see yourself in the same location? Do you see yourself expanding? Do you see yourself refinancing? And then what I do is I also set up a call with our swap desk, so we can kind of say to them, okay, based on the terms that we've laid out to you on a swap, let's go over and show you what a sensitivity analysis looks like. So it shows you kind of as you go through, as your swap runs through the payment stream, okay, after 5 years, here's where you'll be depending on where interest rates go. So they can kind of start to conceptualize, okay, here's my risk involved with this, and here's my benefit involved with it.
So that's why the clients that I deal with you that didn't have a lot of questions or problems. That now I see why, because others were like, didn't they explain this to you? No, it wasn't you. It wasn't yours. And the people I'm referring to.
I said, yeah.
They were like, yeah, well, okay, I expected that. I'm like, but you have the liability. So the important thing is that I always try and say in these sessions is talk to the professionals. I handle accounting, tax, I handle that aspect. But as it relates to swaps, they need to talk to somebody like you, as you said, because you bring your swap desk in. Mm-hmm. And you're not just saying, oh, it looks like this. You get all the people that involved that you need to hear from to have a good understanding of something.
And it's interesting that you brought up about the liability aspect, because I think that an important question to ask for a borrower who's going to engage in a swap with their bank, especially if someone who has a leverage covenant. Talk to your bank about that. How is this going to impact my leverage covenant? If all of a sudden now you've got this liability on your books and it trips the covenant, well, we've all engaged in this transaction. We didn't know where market rates were going to go. So I think that you need to establish, when you're going into a swap, especially if you have a leverage covenant, talk to your bank and say, okay, well, how do we account for this in the covenant, whether it's written out of the covenant or whether part of it's written out of the covenant. It's a discussion to have. Ask the question is my recommendation.
I say it all the time. I tell my clients all the time, talk to your banker. They don't want to find out about it when they get the financial statements. Mm-hmm. Talk to the banker.
What's the word? If you preempt it and you ask the question, the worst that can happen is they say, well, it's going to be X. And you say, well, that's not work. And then maybe the swap doesn't work for you. So it's better to know that now or beforehand than when you've locked in.
Great. Well, Steve, I thank you for giving us all this information on interest rate swaps. And there's a lot more, but this is just a starting point for people to call you and find out more about it. They're very good, potentially a very good tool for some companies, and they should be talking with you, especially in this lending environment. So thank you very much for today.
Thank you very much, Brad.